Sustainable investing, often synonymous with socially responsible investing, has emerged as a transformative force reshaping the investment landscape. This approach goes beyond traditional financial metrics, incorporating environmental, social, and governance LS factors into investment decisions. Sustainable investing represents a paradigm shift, reflecting a growing awareness among investors that financial success need not come at the expense of environmental and social well being. Environmental considerations within sustainable investing encompass factors such as a company's carbon footprint, energy efficiency, and overall impact on ecosystems. Investors increasingly seek to allocate capital to companies that demonstrate a commitment to sustainable practices, including reducing greenhouse gas emissions, conserving natural resources, and adopting renewable energy sources. Climate change awareness has propelled environmental sustainability to the forefront of SG considerations, influencing investment decisions and driving demand for environmentally conscious investment opportunities. Social factors encompass a broad range of considerations, including labor practices, human rights, diversity and inclusion, and community impact. Investors are increasingly focused on supporting companies that prioritize fair labor practices, promote diversity at all organizational levels, and contribute positively to the communities in which they operate. Issues such as employee well being, supply chain ethics, and community engagement are integral to the social dimension of SG, reflecting a broader commitment to ethical and responsible business practice. Governance, the third pillar of SG, centers on the systems and structures that guide a company's decision making processes and ensure accountability. Strong governance practices include transparent financial reporting, ethical executive compensation, and effective risk management. Investors recognize that companies with robust governance structures are better positioned to navigate challenges, adapt to changing market conditions, and sustain long term value. By considering governance factors, sustainable investing seeks to align investor interests with companies that prioritize ethical conduct, integrity, and responsible management. Sustainable investing is not solely driven by altruistic motives. It is also grounded in the belief that companies with strong SG practices are better positioned for long term success. Numerous studies have suggested a correlation between strong ESG performance and financial outperformance. Companies that effectively manage SG risks and opportunities are perceived as more resilient, adaptable, and better equipped to navigate the evolving business landscape. This perspective has contributed to the mainstream adoption of sustainable investing strategies by institutional investors, asset managers, and individual investors alike. The integration of SG factors into investment decisions is facilitated by the development of SG frameworks, standards, and reporting mechanisms. Organizations such as the Global Reporting Initiative GRIT, the Sustainability Accounting Standards Board, SPOB, and the Task Force on Climate Related Financial Disclosures have played instrumental roles in establishing guidelines for companies to disclose relevant SG information. These frameworks enable investors to assess and compare the SG performance of companies, fostering transparency and accountability within the investment ecosystem. Investors can engage with companies on SG issues through shareholder advocacy, proxy voting, and direct dialogue with corporate leadership. Shareholder resolutions addressing SG concerns such as climate change mitigation or board diversity have gained traction, reflecting investors' desire to influence corporate behavior positively. Engaging with companies on SG matters serves not only as a mechanism for driving change, but also as a means of fostering a culture of corporate responsibility and accountability. The exchange traded funds, FTFs. and mutual funds dedicated to sustainable investing have proliferated, offering investors a range of options to align their portfolios with their values. These funds often employ screening processes to include companies with strong ESG profiles or focus on specific sustainability themes such as clean energy, water conservation, or gender equality. The availability of diverse sustainable investment products has democratized access to ESG aligned portfolios, allowing a broader range of investors to participate in the transition toward more sustainable financial markets. As sustainable investing continues to gain momentum, challenges and debates persist. Defining and standardizing SG metrics, addressing greenwashing concerns, and navigating the balance between financial returns and social impact are ongoing considerations. Nevertheless, the undeniable growth of sustainable investing underscores a fundamental shift in investor preferences and signals a commitment to creating a more equitable, sustainable, and responsible global financial system. In essence, sustainable investing represents not only a financial strategy, but also a collective effort to leverage capital for positive environmental and social outcomes, fostering a more conscientious approach to the allocation of financial resources.